Bitcoin has seemingly regained a lot of strength and has broken out of its inverse head and shoulders. And whilst the sentiment is back in greedy territory, does by no account mean the danger's over. Far from it, for we are right in the midst of it. Bitcoin has broken out of the inverse head and shoulders that we discussed in detail in the last episode. The bulls are happy and the sentiment index is back again at greedy levels, and especially so as Ethereum has breached the $3,000 mark. Yet this does by no account mean things are safe and sound for new Bitcoin all-time highs. In fact, Bitcoin is trading right within a massive danger zone, a high risk and low reward area in which you don't want to enter any longs. And this is exactly what we'll discuss in today's episode. But before we get into that, do note that nothing in this episode is financial advice. Everything I say is my own opinions and conclusions only. And equally so, if you like this channel and if this episode helps you better understand what's really going on in Bitcoin, then please hit the like and subscribe buttons and share this episode with others who may be interested and invested in Bitcoin too. Let's now take a look at the technicals and their respective long-term and short-term dangers. First of all, I am not happy with how April played out. That cooling off that we wanted for a sustainable markup just refused to materialize. Instead, Bitcoin shot up last minute for a monthly RSI closing at the stupidly high level of 89.88. To those of you who may not be entirely clued in on the RSI, the higher the time frame, the narrower the normal RSI fluctuations. If you look at any 15-minute chart, you will frequently see RSI values above 90 or below 10. But the higher the time frame you apply, the narrower that span becomes. Monthly RSI values in the 90s are very rare. Just take a look at any stock index or equity graph on the monthly chart and you'll know exactly what I mean. And for more on the RSI, please watch the RSI trilogy. It really goes deep on everything you need to know about this remarkable indicator. Sure, the RSI can remain in ultra-high territory for extended periods of time, and for the monthly RSI, ultra-high constitutes approximately 85 and above, but eventually it always breaks. And if we look at it historically, any time Bitcoin has traded at this current level or above, it's been dancing near the exit. My concern is that this turn of events drastically shortens this markup's expected longevity. With that said, a weak month of May could significantly prolong this very markup and equally significantly decrease the risks towards the new peak. This sure is something I'd welcome with open arms myself. Of course, I will still long Bitcoin if or when it reaches a safe level, and we'll discuss those levels in just a bit. The difference is that unless we get a correction, such long will come at a much higher risk, and I will therefore keep a constant eye on the fire exit, as these overstrained technicals can either set off a severe temporary correction or end this markup prematurely, thus causing us all to miss out on a lot of value. And this is serious stuff, and I cannot underline it much enough. With that said, let's now take a look at the short to mid-term dangers and possibilities. Starting off on the 4-hour chart, Bitcoin broke out of its inverse head and shoulders, which technically has a target at around 63,500. This though doesn't mean it must go there. Sometimes the targets fall short despite an outbreak. For more on those exceptions and the proper statistics behind them, I propose you read Thomas Bulkowski's Getting Started in Chart Patterns, linked to in the description. This book is a must-read that I personally keep coming back to, and I often use it for references too. And what further decreases the chances of Bitcoin reaching its ultimate technical target is the resistance zone right above, between the $59,000 to $60,000 mark, for we have a lot of reversal action here amidst the 2-month rising wedge. But here's the thing, and also wherein the real danger lies: even if Bitcoin were to break above this resistance zone, it is not safe at all to enter any longs before it manages to close above and stay above $61,000. Here's why. First of all, we have a 786 fib, which nicely coincides with a horizontal resistance. This on its own is of course nothing remarkable. What's rather important about the fib is that until Bitcoin manages to take out the 786, a downwards reversal is still in play. Once it breaches this final key fib level, however, statistics tell us that we should expect to test the previous pivot, or slightly short of $65,000 in this case. For statistically, we don't see reversals in the no man's land between the starting point and the 786 fib. Of course, it still happens, it's just rare. And the 618 and 786 fibs are always the critical areas that need to be broken whenever a stock, equity or asset tests them from below. For upon pretty much every reversal, whether before a C-wave correction or a markup to distribution swap, the price tends to test either of the two. With that said, this is not the zone in which you want to enter longs. It's a minefield. Secondly, any move towards either the horizontal resistance zone or the 786 fib could potentially align perfectly with a daily close on the upper bearish blue, and that's certainly not when you want to be involved in long positions. And thirdly, and most importantly, we may be in for a big ABC correction, and this would make a lot of sense. The market is often full of nasty surprises, and with an emphasis on nasty. There was no real pain inflicted to the average retailer before reversing back up. This recovery was rather a bit too expected, and it let the market off the hook a bit too cheaply. A C-wave correction, on the other hand, would come out of left field and kill off a lot of bullish sentiment, which in turn has already flipped to greedy. And as the A and C waves remarkably often tend to be identical in either length or extent, a C wave would perfectly align with the $42,000 to $45,000 zone, depending on where Bitcoin tops out with its B wave, and whether we measure the C wave in actual numbers or in percentages, regardless of which the span beautifully lands us in the $42,000 to $45,000 range. Whether this prospect correction is a zigzag as in a 535 wave structure or a flat of any kind as in a 335 remains to be seen. What's at least key at the moment is that the ultimate C wave target stands at 42 to 45,000 and nothing else. If this were to play out, that is. With that said, I'm more bound to treat this as a zigzag because of its triangular correction, which is typical for fourth waves, which in this case would be the fourth wave of the A wave correction. And to add weight to the C wave argument, I am not impressed by the trading volumes that have carried this move up, especially not throughout the latter half of it. Now, unless Bitcoin takes out 61,000 and stays above it, a C wave correction still makes the $42,000 to $45,000 area intact depending on the actual reversal point. Only a sustainable break above 61,000 would neutralize a potential C wave amidst a 786 fib breach. This is equally so the level I'll be looking at re-entering with my all-in, as there's neither any resistance above that level to speak of. With that said, Bitcoin will constitute much more risk over the upcoming weeks compared to if it had instead cooled off. Something I will simultaneously keep a close eye on is the Ethereum versus Bitcoin technicals, which are currently testing that key resistance at 0.053 that we've been talking about at length throughout this 2021 Bitcoin series. If Ethereum manages to break above it, then it should be a fast and smooth ride towards the 0.084 level. And in such case, being overly weighted in Ethereum will be the correct move. And if not, as in if this 53 level were to hold up, then expect some duly needed correction in Ethereum, as it's already rallied by 150% in just 2 months. I don't know where Bitcoin's going, but I sure know how I'll play it. For at the end of the day, all we're here for is to bend the odds in our favor. Here's my strategy. Either I'll re-enter with my all-in if or when Bitcoin were to break above and stay above $61,000 within a near future, and I will enter such trade with a tight stop loss in the mid $58,000 range for a 4% overall risk, or I will re-enter in the $42,000 to $45,000 range if that C wave were to play out. And whether that all-in re-entry will be in Bitcoin or Ethereum entirely comes down to which side of the fence their internal technicals eventually fall to. To sum it all up, Bitcoin is trading within a high-risk area. I will exit the long I took on Friday, which I also communicated on Twitter, and will re-enter with my all-in either above $61,000 or in the $42,000 to $45,000 range, unless anything changes in between. That was all for now. Thank you and goodbye.